Good evening, everyone. It's 7 o'clock. This is Yang Wang from Greenwich Library. Welcome to the Greenwich Library's investing discussion series. Before we start, let me give a brief introduction of the speaker today, Kristen Jacks. Kristen Jacks is a financial educator, author, and the founder of Money in Your 20s. Kristen worked for Kiplinger's Personal Finance magazine and a mutual fund magazine before becoming a writer and a speaker. Her new book on investing is a lively and a jargon-free resource for young adults or anyone new to investing. Kristen is a graduate of Duke University. Today's topic is psychology of investing, and the next session would be on May 28th, and the topic is investment basics, research tours. Okay, let me turn the screen to Kristen. Thank you, Kristen.
Thank you, Young, and thanks so much to Greenwich Library. They do such a great job with programming. They offer such great programs, and they're all free, which is fantastic. Okay, welcome everybody. This is the Investing Discussion Group. Believe it or not, this is season 3 of our monthly discussion group. And this season, we always have a theme for our season. This season was As You Requested. So it was really interesting to reach out to the different people who've participated, find out what you most wanted to have us cover. And the economy and why is the economy important was a big thing. Asset allocation, saving for college. Tonight's theme, which is about psychology, like cognitive biases. And taxes is always a big theme. So we've really covered a lot of great ground this year. And if you missed anything, all of these videos live on the Greenwich Library YouTube channel, which is very easy to find. You just go to YouTube and in the search bar, put in Greenwich Library. And then you'll see this kind of green, like it's the open book with the white tree and the green open book with the white tree in it. That's the Greenwich Library logo. You'll see that and click on that. And then it takes you to all of these past videos. For example, like Bond Bombshell was a really popular one. The asset allocation was a really popular one. And it has all the past 3 seasons on there. So you can just pick and choose whatever is of interest to you. Real estate investing was another really popular one. So lots of great offerings that live on the library's YouTube channel. And I know Young always tells me that these also live on the library website. Maybe she can put in the chat box like the link or how to find that, because I actually don't know where that is on the library website, but you might not even have to go to YouTube.
I will add the link to the chat box.
Oh, perfect. Okay, thank you, Young. So anyway, welcome tonight. Today, we're doing the psychology of investing. And then our last webinar for this season, because we take the summer off, our last webinar is in June, and that's The Millionaire Next Door. We're not covering the book so closely, but a lot of sort of the major themes of The Millionaire Next Door, which is a fantastic bestseller, but really just how it relates to investing and how really how do you grow your wealth truly with investing? And it's not necessarily what you may have been taught to believe, or you might just assume what works. And then Young was mentioning something else about investing basics. So you have another webinar coming up. Is that with Julie that you're doing investing basics? Well, Young?
Yeah, Julie Jason.
Oh, okay. And that's May 28th?
Yes.
Oh, very good. Yeah, you guys just have fantastic programs. It's just so wonderful.
Thank you. Oh, by the way, we have another a session, just 2 series session on trading strategy in July. That's by a professor from Columbia University. So please check our website, look for the calendar of events for July. We have 2 programs in the evening online for it's totally about investment. It's about strategy. It's more technical. It's for more for individual investors who really wants to know the strategy. The speaker is a professor from Columbia University, and he also runs his own investment company firm.
Oh, that sounds great. You guys are amazing. You really get wonderful people. Okay. So today we're doing the psychology of investing, and just a few quick definitions. You know, psychology is the study of the mind, how it works, how it impacts your behavior. And then we also have to talk about economics, because when we get into the psychology of investing, you know, we're not doing this based on, you know, our own theories or things we've observed. We're really getting into the science behind decision making around investing. And when you get into decision making around investing, you're really getting into economics, because economics is the study of making choices when resources are limited. And if you didn't know that was the definition, it's because there are many, many definitions of economics. So I'm taking this definition from the University of Buffalo because it's the most relevant to what the topic we're doing tonight. But I mean, there's so many different theories of like how economies work and things like that, and supply and demand and things like that. But for our purposes, we're really talking about looking at how we make choices when our resources are limited. So, you know, investments are technically a limited resource. You know, that's why the prices get bid up or down, because there's sort of an auction around whether or not people want those assets, right? And the decision you're making of whether or not to buy or sell. So we're really going to look at actual true data from economists, from the best economists out there. Oh, Young, can you mute anybody who's not Young?
Okay, I'll do it.
Okay, thank you. All right, so what's the best use of our 80 minutes we have left here? So, like I said, economics underpins what we're talking about here. And it's really interesting to look at the history of how economists have looked at investing behavior, and how the pendulum kind of like, you know, swings one way and then it swings back. We've kind of come full circle, and I'll show you what I mean by that. But we're going to start with the history of what the economists have been saying about our investing behavior. And then we get to the very recent Nobel Prize winners, where you really see that like behavioral economics is on the rise, and this thought that that you have to understand the psychology, that people really are, you know, suffering from cognitive biases, that they're not being that rational, that they have sort of this system one thinking where they're using their intuition, they're not usually using their best judgment. So we're going to cover all of that. And we're going to cover just very briefly, the book Thinking Fast and Slow. There's a reason why it was a bestseller, because that's kind of our entry point to understand why, you know, how our mind works. And because our mind has these two systems in theory, that, you know, system one is this sort of like knee-jerk, intuitive, emotional system that's kind of letting these cognitive biases take over. So again, this is where we're getting into the psychology, where it's like, how does our mind work and how is it impacting our behavior? And we're going to see that like we don't actually use the most sober, slow judgment when it comes to investing, even though we should. And then we're going to talk about some of these biases, right? So this is the psychology of investing. The research is showing that we have these patterns of behavior that are biased, and they're predictable, and we should at least know what they are. They're not always terrible, but at least if we know what they are, then we can predict them and maybe kind of conquer them and get ahead of them. So we're going to look at these predictable pitfalls, and we're going to try to avoid the worst so that we don't make classic mistakes. Like, the idea is to buy low, sell high, not sell high and not sell low and buy high. So we're going to avoid the worst behavior. And then finally, hopefully we can profit from the biases of others. I mean, if this is pervasive in the culture that people are making these knee-jerk mistakes, and at the end of the day, these assets are kind of at an auction, and you're going to be able to get something at a lower cost because of the mistakes other people are making. So that's something that could be fun for you, a good profit. I'm just going to take a quick look at the chat because I see that we've got 4 things in there. Is that
No,
all?
I posted about the links and the programs in July.
Oh, perfect. Okay, that is great. Okay, but quick disclaimer, because we're talking about investing. This webinar is for educational purposes only. It is not intended to provide investment advice. None of the investments mentioned in this discussion group are recommended or discouraged. Before making financial decisions, you are urged to consult a wide range of professionals, a tax expert, lawyer, financial advisor, who are aware of your unique needs and situation. And also, please participate. I know it's a little tricky on Zoom. It'd be, easier if we were all together in the same room, but you can always put a question in the chat, or you can always unmute and ask a question. I'll try to remember to pause. That usually helps. But we definitely want this to be a discussion group and not just a lecture. Okay, so let's look at this history. We said we were going to start with a history lesson. And it's kind of fun to look at how economists, the theories that economists have had, and how the pendulum, was all the way to one side with people talking, like John Maynard Keynes, one of the most famous economists of all times, in the 30s, he was just openly talking about emotion and bias and instinct and how man is not rational and man has hopes and fears and all sorts of stuff. And people thought that was very normal, right? That a top economist would speak in those terms seemed very normal. And then you had the pendulum swing where you had very, very smart economists from University of Chicago, MIT, Princeton, Harvard, and they really wanted what they were saying about behavior and decision making when resources are scarce. They wanted it to seem much more like a hard science and much more rational and mathematical. And they didn't really want to get into emotion and bias and hope and fear and that kind of language. So there was this real push to make economics, instead of like the dismal science, like a hard science. And so then all of a sudden, this language of sort of the irrationality and the emotional person got removed. And then we keep progressing. And then there's this rise of behavioral economics where we're really kind of back where we started, with accepting that people are not rational under certain situations, that they do let their emotions get the best of them, that they have certain biases that are, we can call them because they're predictable, because these patterns have been noticed in research. We can name certain biases, and the science would say that they are real because they are repeated, that these are repeatable phenomenon. So now the pendulum has swung back, and we're back to thinking about emotion and biases and things like that. So it's kind of fun to look at this, where we started out with Keynes, and he would talk about animal spirits, which would refer to like the instincts and emotions and the psychological factors that drive economic decision-making, particularly in investments. And, he was like, this is beyond rationality. These are non-rational impulses, like including like overconfidence or hope, fear, pessimism, things like that. And his theory was that because of all these emotions that were not fully rational, you had like boom and bust cycles. And people thought this was a completely normal way to theorize and a totally normal way to talk. And about the same time that Keynes was writing this, you have Benjamin Graham, who's considered the father of value investing. The way he talked about how the markets behave, and he would say that basically the market is bipolar, right? And the way you could think of the market and the pricing in the market is as though you had a business partner who on any given day, one day he wants to sell you his share of the business for an unusually low price. And the next day he wants to sell you his share of the business for an unusually high price. And implicit in all of this was like irrationality and mania and high and big swings and things like that. And people accepted this as a completely normal way to talk about the pricing of investments, investor behavior. So this was just common, right? And then the pendulum swings, and you get people like Paul Samuelson, who is a really, really famous economist. And he is credited with really bringing economics to, just adding like definitely math, like methods and math to economics. And so he's at MIT, and Eugene Fama is at U Chicago, and they start producing all of this research that's based, much more on man being rational, much more on mathematical models and a hypothesis of like an efficient market and things like that. Now, Paul Samuelson actually really liked Keynes, but what he called himself like a cafeteria Keynesian because he was going to kind of pick and choose among the things that Keynes had said. But he was, instead of talking about like emotion and instinct and irrationality, he was just going to say whatever Keynes had proposed, he was going to sort of show the mathematical side to it or the predictable, methodological side to things. And then Eugene Fama is just like a super, like a hyper rationalist. So these guys come along, and Burton Malkiel at Princeton. So the rise of these like hyper rational academics who really they're trying to make economics a hard science and relying on math. And for example, the Nobel Prize Committee, when Samuelson was winning his Nobel Prize, they said of Samuelson, more than any other contemporary economist, Samuelson has helped to raise the general analytical and methodological level in economic science. So irrationality and mood and emotion, all that stuff was out. And rationality and hyper rationality and maximizing, your decisions was in. And the decisions that people were making were thought to be like very utilitarian, right? That people were like guided by their own self-interest and not really swayed by hope or fear or pessimism or overconfidence or things like that. So that's all happening in the 50s, 60s, 70s. And then, since that, didn't work so well, didn't fully explain things, I love this quote from Peter Lynch, where he said that academics taught him that the things he saw happening at Fidelity couldn't really be happening because everything became so hyper rational and so hyper predictable. And he was like, that's not really how investments perform or how people act in the face of investing. So I thought that was pretty hilarious. So then the pendulum starts swinging back. And, Eugene Fama is a Nobel Prize winner. Paul Samuelson's a Nobel Prize winner. It's not like these guys have gone into obscurity, but there's definitely the sense that behavioral economics is on the rise and that we're getting back to this sense of people having biases and being moved more by like impulse and emotion and things like that. So that's why I say the newer Nobel Prize winners have a point. So these new Nobel Prize winners are Robert Shiller at Yale, Daniel Kahneman, who's, I'm sure if you know anything about behavioral finance, you've heard of him. He's kind of like the father of behavioral finance. And Daniel Kahneman is an Israeli psychologist who actually won the Nobel Prize in economics because his psychological theories really like informed like how people were making their decisions in, within scarce resources, which is economics. And then of course there's Richard Thaler, who wrote Nudge and Misbehaving at the University of Chicago. And I guess a lot of people would say that he's the father of behavioral economics because he's actually an economist. But Thaler and Kahneman are like best friends, and Thaler kind of credits Kahneman with getting like the whole thing started. So what does this all mean, like getting it started? Well, Thaler, so Kahneman, who worked with a guy, Amos Tversky, who sadly died in the 90s. He died only at the age of 59. But they were two Israeli psychologists, and they started doing all of this research around decision-making and finding, and really doing compelling research showing that people had very flawed thinking and very flawed patterns of behavior, and these flaws were very predictable. And they coined the term cognitive bias to sort of, as an overall name for what they were finding of these like kind of predictable flaws in people's thinking. And these were psychologists, so it's like how the mind works and then how it affects behavior. Okay, so before we get to the cognitive biases, I want to talk just briefly about Thinking Fast and Slow, which was Daniel Kahneman's bestseller, because if you believe what he is saying, and he is a Nobel Prize winner, he's sort of introducing, it's like, well, how does this bias like get into our behavior? And he has this bestseller called Thinking Fast and Slow, where based on ample research, he's like, if you really look at how the mind works, it's as though we have two systems. We have a system one in our decision-making that is fast, intuitive, emotional, And then we have a system 2 in our thinking and deliberating and decision making that is much slower, more logical, more deliberative, right? And in your own experience, this kind of makes sense, right? I mean, we would be exhausted with all the decisions that we have to make, all day long, right? You're driving your car. Do you slam on the brakes? Do you swerve out of the way? There are certain things where you have to have like an intuitive and a fast reaction time. You see somebody walking towards you. You don't know if they look like friendly or unfriendly. I mean, there are all these things that we're doing every day that if we did everything slowly and more deliberatively, we would be exhausted. And also, there are certain situations where you have to react quickly. So slow would actually be really bad. But the problem is you're also forfeiting maybe your best judgment, and you're also forfeiting some logic when you're using your system 1. And Kahneman talks about how, like, obviously there's nothing like inside your brain that is system 1. there's no anatomical thing that is system 1. He's just showing that these are sort of 2 basic ways our brain works. And you're either going to have like this fast, intuitive, emotional response, or you're going to have a slower, more deliberative, more logical response. And people clearly thought this made a lot of sense because Thinking Fast and Slow became a bestseller, and it's referenced all the time, and it's been very interesting among academics to be thinking about this. But you have to understand that if people are accepting that this is true, that there is a system 1, and then that's the entry point for the whole idea of there being a cognitive bias, right? So in order for these cognitive biases to matter, you have to have an entry point in the way we think where we will be intuitive and emotional and less logical, and we'll do it quickly. and that's where you get these, that's the entry point for these cognitive biases. So when we're not in system 1, when we are being slow and more deliberative and more logical in our system 2, then the biases kind of disappear, because then we're really taking our time and not having knee-jerk reactions. Okay, so what are these, what are there are so many biases, by the way. I mean, if you go to Google and you put in cognitive biases, you'll get a list of like 60 or 70. It's exhausting. So I'm just looking at the ones that I perceive are the most relevant if you're going to be an investor. And these have been very well studied. They've been, I want to say repeatable. What's the word they use in research when you can, I mean, it's very important that if somebody does research and they notice a pattern, that how that same pattern can be repeated by other researchers in another location, right? I think they have a different word for it, but the biases I'm going to show you are, really based in research, have definitely been repeated, independently by different research teams and things like that. And they're very relevant to investing, but just keep in mind that what I'm showing you is only a fraction of what's actually out there. Okay, so probably the most important for the psychology of investing is this phenomenon of loss aversion. And maybe this seems kind of logical to you, but at the time, people would have said that, as long as you are reasonably well off, right? You're not worried about where your next meal is coming from. You're not in dire straits, right? That if you are approaching investing, it would be great if you purchased an investment and you made $100. And it wouldn't be ideal, but it would be okay if you purchased an investment and lost $100, right? Well, loss aversion is this phenomenon where, so Kahneman and Tversky, while they were Israeli psychologists doing active research, they discovered that our reaction to loss is a loss is twice as painful to us, and or just like the feeling, the sense of a loss has twice the impact as a gain, right? So you have like a relatively good feeling about a gain, but you have whatever that emotion is, it's twice as strong for a loss. So we are very, very loss averse. So losses really feel terrible to us. And maybe this sounds logical, but it can really wreck your investing because the market goes down all the time. And there's so much research about the market going down, really with like no explanation. I mean, you might think that like tariffs was, the tariff crisis or whatever was enough of an explanation to explain how much stocks went down. But really, in the long run, like this happens all the time. There could just be some macro event that is jarring, and then people overreact, and then stocks start to slip and slip and slip and slip. And the problem is, it happens all the time. But if we are experiencing the loss aversion and we don't understand how the losses are going to just feel terrible to us, then we might overreact and we might sell just because stocks are going down, but stocks go down all the time. And later on, we'll probably use a few examples, but you just have to know that loss aversion exists. And the idea that losses are so painful to us is one of the cognitive biases that kind of defies logic because loss is so much more painful. Okay, another bias is overconfidence. And this is kind of hilarious, right? Like you hear about this in the news where there'd be like 92% of people say they are above average drivers, right? And not me. I don't say that. I am a decidedly below average driver. But this whole idea, and this is actually scientifically, it's called the Dunning-Kruger effect, where it's this phenomenon in which people with low ability or low knowledge in any given area overestimate their competence. And then on the flip side, which is really interesting, so you have people who they have no business being confident in a certain area, right? I mean, to pick anything, right? Go to axe throwing. People like to go to axe throwing now, like to pick anything, and someone's had like no exposure to it. And, if you ask them at the end of an evening of axe throwing how they did, they would say, well, I think I did better than like 75% of people, right? Even though it was their first night doing it. I mean, this is like a known effect. Pick any topic. It's like people who have very low skill, very low exposure will say that they were way above average. They feel confident when they shouldn't. And then on the flip side, people who've actually had a lot of exposure, who are very knowledgeable. And again, like pick any topic. It could be like someone who's like really good at math, or someone who's really good at vocabulary words, right? When you ask the people who are actually considered the best, like the top quartile, how they think they did on a test, they usually, they're not being modest even, they just don't think they did particularly well compared to others. They might think, oh, well, it's probably like a little bit better than average, but not great, which is so surprising because these are the ones that are in the top. So this is this Dunning-Kruger effect where we really misunderstand, like when we have low ability, we're overconfident. When we have high ability, we're too humble. So we kind of mess up like what our competence is, which of course, if you're picking investments, that would really matter. Like, should you even be picking investments on your own without the help of a financial planner or without the help of like a lot of advice from someone who's more knowledgeable? That's a good question. So, all the time I deal with people who certainly these young people. So my first book was Money in Your 20s. And so I have the privilege of talking to a lot of young people. And it's so interesting to me, the ones that like, they get that Robinhood account and they are trading options, like 22 years old trading options. And I'm like, you could do that. I mean, there's someone on the other side of that bet that is totally happy to take your money, because I'm sure you shouldn't even be picking a particular stock, but you absolutely should not be doing options. You have like no business doing that, but it happens all the time. It's probably one of the ways that Robinhood knows it can make money is that there's this endless supply of people. I'm sure sports betting is the same way. There are all these people who think they're going to be much better at predicting things than they actually are. So the Dunning-Kruger effect is really, really important. And the one side of it that's super, super important is this overconfidence side. Okay. And just so you know, like everything that I'm showing you here is very scientific, right? So if it made the list, it's because different research teams, whatever research team first noticed it, this has been replicated. Okay, thank you very much. Replicated. That was the word I was looking for. I mean, it is repeatable, but replicated is the word I was looking for. So all of these biases have been identified and then replicated by other research teams, doing their own independent research. So, there's definitely the Dunning-Kruger effect has been noticed over and over again. Loss aversion has been noticed over and over again. And then recency bias is really, really interesting. So it's this bias, it's the tendency to overemphasize the importance of recent experiences or really recent information, right? So, I mean, honestly, I can understand like tariffs could be jarring, right? So I'm not necessarily going to make a case that like you shouldn't overreact to tariffs because it can have such an impact on the sales of the company and the pricing of the product and things like that. But take something else, like just take, it's a quarterly report, like the quarterly earnings, any company doing quarterly earnings and they have a bad quarter. All they did was have a bad 90 days, right? And the stock price is supposed to be based on at least today to the next 10 years out, right? I mean, stock prices are supposed to be based on future earnings, the discounted, like you look at the first future earnings and then you discount the cash flows back. And, it's supposed to be mathematical and thoughtful and all these things. And it's amazing how often just one bad quarterly report will sink a stock. And that makes no sense, right? Because even if a company has a bad quarter, you're supposed to be like, the viability of this company, the sales, what's going to be going on, 6 years from now, 7 years from now, has nothing to do with the recent quarter. But there is such a tremendous recency bias. And I'm sure it's on the flip side too. I usually just try to take advantage of stocks that are getting, in my opinion, overpunished. So I kind of use the recency bias that way. But I'm sure like, a stock can report like strong earnings and the stock goes way up. But that's backward looking, right? I mean, strong earnings are great, but that's what happened the last 90 days. And the price of the stock is supposed to be based on like the next 10 years. So again, there's this recency bias in everything that we do, that we overemphasize recent events and we don't take the long view, right, at all. All right. And then, of course, confirmation bias is at work there. So you're already overconfident, and maybe you have some recency bias, and now you're going to make these decisions, and you're going to look out in the universe for anything. You're only going to pay attention to the things that confirm that you are right. That whatever action you're about to take, whatever point of view you have, whatever decision you're going to make, you are going to ignore the information that would question the wisdom of your decision, would question the wisdom of the thing that you want to invest in. And instead, you're just going to scan the universe and only pick up those things that confirm your bias. This is a big problem, right? Like, you should be open to challenge. You should be open to pros and cons, right? Let's just not that you shouldn't do what you want to do, but you should be open to pros and cons and really weighing the pros and cons. But unfortunately, that's not how our brain works. Our brain kind of goes out and scans the universe for evidence that we are right. And that can be very problematic, obviously. Okay. And then one of my favorites, action bias. So we just have this tendency to favor action over inaction, which if you go back to, when we were trying to survive out in the wild, that would make a lot of sense, right? You see something dangerous, you want to flee, you want to take some action. The things that the threats we used to experience. It wasn't so much like a psychic threat, it would be like a physical threat, right? So it would make sense to have an action, to be action oriented, to run, to hide, to put out the fire, to, I don't know. So, anyway, so the action bias describes our tendency to favor action over inaction, and it's often to our benefit, right? However, sometimes we feel compelled to act, even if there's no evidence that it will lead to a better outcome than doing nothing would. So our tendency to respond with action as a default. And so I can't remember, maybe it was John Bogle. I'm trying to think of these really, really wise lifelong investors who is the person who said, instead of don't just stand there, do something, it was like, don't just do something, stand there. So like turn it around. Like, definitely if there's a panic in the market or things like that, it's like, do not let that action bias kick in, because very often inaction is a much better response. You want to just sit out the storm, right? Don't take any negative actions. Okay. So to sum up, I love the psychology of money. We actually did a whole webinar just on the psychology of money by Morgan Housel. And at the time, he had sold 2 million copies of The Psychology of Money, a great book. We have plenty of copies of The Psychology of Money at the library. But to sum up, Morgan Housel is like, listen, you're not a spreadsheet. You're a person, a screwed up, emotional person. So when you face, he talked about money very broadly, right? He was not talking just about investing. He was just talking about the big, big, big picture. And so we're drilling down much more into investing, but he just wanted us to understand that, like, you really have to get in touch with your sort of irrational side. Actually, he would not have said that anybody was irrational. In fact, he begins his book with, I think the first chapter is called No One's Crazy, because he's sort of defending that, like, whatever your bias is, it's based on your experience, which was a little bit recency bias, but it's like, it's your recent experience. So like whatever you've experienced, like, kind of becomes the thing that dominates your mind. But Morgan Housel's like, you're not a spreadsheet. You're a person, a screwed up emotional person. And we're all better off if we understand that, no matter how smart we are, no matter how hardworking, no matter how dedicated, that we have this system one thinking that leads us to knee-jerk reactions, that we have all these biases that we're going to be prone to. And then we also, we just get tired, right? So in these, 12-step program, different addiction programs, I think they call it HALT, like hungry, angry, something, tired. Hungry, angry, can't remember what the L is for, tired, right? We're just human, right? So we got to be careful. We don't want to make decisions when we're hungry or angry or tired or any of those things. So the more we realize that we have, this potential for going astray, the better off we are. Okay, I'm just going to pause for 1 second. So I'll go back and just mention these biases. There's loss aversion, overconfidence, but really just this is the whole Dunning-Kruger effect, where it's like you're overconfident when you have low ability, you're kind of too humble when you have high ability. There's the recency bias, there's confirmation bias, there's action bias. So these are like the big guns. So if anybody has any questions or comments, you could please feel free to weigh in or put something in the chat, because I just want to slow down a little. I'm a very fast talker, but I want to make sure you're with me on all of this. And maybe now, let me see, maybe the next one is, so this is everything that we've been covering, the whole history lesson in the beginning, and then the Nobel Prize winners, and then the book Thinking Fast and Slow, and the most relevant biases. And as long as you're still with me, that's great. But if anybody has a question, I just want to pause for a second. I'll just take a quick look in the chat. Let me take a look. One new message.
You didn't miss anything. That was my post. I was answering a patron's question.
Oh, okay. Okay, great.
You didn't miss anything.
Okay, great. All right, so let's get into this, the pitfall behavior. So we want to avoid the worst. So there's a company called Dalbar, and for years and years and years, they have been doing research looking at, there are market returns, right? Just meaning like if you just look at like usually I think they do the S&P 500, just what did the S&P 500 return year after year after year? It's up 17%, it's down 4%, it's up 11%, it's up 10%. Ironically, like people have become accustomed to hearing that the market on average is up between 8 and 10%, but in reality, it is almost never 8, 9, or 10%. So this is how these averages work. It's like it'll be 17%, then it'll be down 2%, then it'll be up 19%, then it'll be down 8%. I mean, it's a very wild ride, but just in general, Dalbar will look at the market returns. So, if you put your money in and then never looked again, you just like put your money in that account, closed it, didn't look again, just let your money do whatever the market is going to do to it. Take that, the market return, versus the returns that the average investor actually gets. And routinely, the returns that the average investor gets are, sometimes dramatically lower. In a more recent stretch, the returns haven't been that bad because people had this. So this data, the most recent data came out before all the tariff nonsense, but people hadn't, been reacting to the tariff stuff. But, when markets just kind of like chug up, then people don't tend to overreact. Maybe they get a little overconfident. Maybe they churn their account too much. Maybe they day trade a little. But certainly when there's market volatility and people panic, you end up with, some of the worst case scenarios, it'll be like, over a certain stretch of time, Dalbar will show that the market return was on average 8%, and the typical investor only got 4%. And that is entirely ascribed to the behavior, the negative behavior of an average investor. And, this is some of the behavior that we, or some of the biases that people have, right? The loss aversion. So the market starts to go down and they panic and they sell. The idea of market timing in general, like, oh, the market's bad now, let me get out. It's like, well, you're not going to get out at the right time and you're not going to get back in at the right time. So you'll probably miss, like when it turns and it rises quickly and things like that. So Dalbar's this company where they release this data and they show, like in the most recent data is that in 2024, because of typical bad habits by investors, like they did not capture the market return. They got 16.5%, the market return 25%. So that's why you have to understand what these cognitive biases are and avoid the pitfalls that come from having these biases. Okay. So again, what are these biases? Okay, I cannot drill this enough, like loss aversion. People hate loss. It is literally painful. It's twice, a loss is twice as much pain as the pleasure of a gain. So, oh, that kind of rhymes. Twice as much pain as the pleasure of a gain. Okay. And this is totally true. I didn't make that up. The twice as much I didn't make up. This is what the research shows. Well, here's the problem. Even under like fairly normal conditions, the market is so volatile. I love Hoka's. I don't know if guys know what the Hoka running shoe is, this craze, right? Forget those Nikes, like nobody's using them anymore. So when I was getting sneakers for my daughters, like, they obviously had to have Hoka's. Everybody has to have Hoka's. And I'm like, well, what is this company that's creating these Hoka's? And it turns out it's the same company that creates Uggs and I'm going to forget the name. Teva. So it's an incredible shoe company that makes the Hoka's, makes the Uggs, makes the Tevas, or however you pronounce them. And I was like, wow, like this company's like really a phenomenon. And at first I thought I missed it, right? Because by the time I discovered it, like the stock had already gone up and up and up and up. But then the tariff, calamity comes about. And okay, let me back up. Trump gets elected, and from the time he gets elected to before the tariff calamity, the stock market was just kind of on a tear, right? And I'm not saying like I'm not pro-Trump, like I'm not saying for that reason, but it's just the timing of it was that the market just kind of zoomed ahead. So the makers of Hoka, so this is called Decker, DECK is the ticker symbol. So the Decker folks, DECK is the ticker symbol. That stock had already risen like dramatically over the last 2 years just because of the whole Hoka craze. But it went as high as like $220 after Trump was elected. And then, and I've always followed it. I didn't buy it because I was like, I missed it. It just got too high. Well, then they have like a kind of not so great, kind of soft earnings report. And the stock goes from 220 to 177, like boom, like sinks like a stone. I'm like, wow. And I'm thinking to myself, that could be a buy. That's interesting. Like maybe I could get in if they're going to have a little bit of bad news. Well, then the tariff calamity comes, and a lot of sneakers are, of course, made in Asia. I mean, it doesn't have to be China; it could be Vietnam and things like that. But this stock that had recently been 220 went all the way into the 90s. I couldn't believe it. I'm thinking this is the greatest thing ever. Like this is where I'm getting lucky. So this panic that sets in, there starts to be a loss. There starts to be bad news. I mean, I can't see how anyone could make the case that Decker with its Uggs and its Hokas could be so decimated, right? But this is this loss aversion kicking in where people like the loss is so painful and then they just want to get out of it. They want to escape it. Well, you're not going to be able to survive stock investing, certainly not individual stock investing, if you don't understand this loss aversion and if you don't manage for it, right? It really is buy low, sell high, right? Not panic as stocks are falling. So the first thing is just understanding that you have this loss aversion, that this is a pitfall. And then the next thing is like, what is your plan for when the losses start to happen? What are you going to do? How are you going to make sure you're not that person who's selling in a panic? And there is some really, really good advice on what to do. First of all, never chase returns, okay? Because, and I do think I have, I just want to see if I have, here we go. Okay, so David Swensen, one of the most famous investors of all time, was asked, like, what is the biggest mistake you see investors make? And he said, if I have to pick one, it's performance chasing, right? So if you were looking at Decker, because you liked the Hokas too, and you saw that Decker had like taken off. Well, I looked at that, and in my brain, I'm like, I missed it, right? The novice brain is like that FOMO, is like that fear of missing out. It's like, wow, that stock is going up, 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 up. Everybody's doing it. I want to jump on the bandwagon. And by the way, there is a bias called the bandwagon effect. And that's called chasing returns. So you're seeing, the stock was at 60, then it was at 80, then it was 110, then it was 170, then it went all the way to 220. If you're buying when it's like 200 on that trajectory, you are chasing returns, right? Because it's kind of left the stratosphere. It's beyond its fundamentals, and you're taking an enormous risk, enormous risk. So do not chase returns. Never do that. Like the worst results for investors. The investors that chase returns, so now instead of buy low, sell high, they are buying high, right? They're chasing those returns, that whether it's Bitcoin or it's a stock or it's like a house that's way overpriced. Stay away from that frenzy. So the most important thing is you didn't buy at a very high price, because then when stocks start to tumble, I think it's the guys at the Motley Fool. I'm gonna blank on his name, but the Motley Fool is a really, really good investing site, and they talk about how stocks take the stairs up and the elevator down. So if you've been chasing returns and something has an asset has gotten really inflated in price, when that bubble bursts, it bursts, right? So this Decker, like imagine you were chasing that return and you bought at 200 and you saw it go down into the 90s. I mean, it lost more than half its value in a few months. That is gut-wrenching, right? And there's no sense, it may never return to that stratospheric level. I mean, today I think it was 130, right? So rule number one, you're avoiding these pitfalls. You have this loss aversion, that's going to feel terrible. But if you avoid chasing returns, then you're never starting at so high a number that you're going to have you're going to deal with the catastrophic loss. That's one thing. So let me go back to that. Where was that? Okay. Okay, so we have this loss aversion. So we're not going to chase returns. That's the worst thing you can do. The second thing is you are never putting money in play that you need. I'm sure you've heard this before, like never, ever, ever invest money that you will need. Like say you're saving for a house and you're like, well, I've saved up all this money for a down payment, but it's just sitting there, and why not? Why not just put it in the stock market? Well, the last couple of months is your reason why, right? Because markets can decline very rapidly, very unexpectedly, very rapidly. And then this money that you need, like if this spring market, you're trying to buy a house, now you have much less for your down payment than you were planning. So some planners call this the bucket system, where you always have the bucket of the money that you're going to need for the next 3 years, right? So whatever your financial situation is, you never have money in the market that you're going to need in the next 3 years. So that's a whole other way to not overreact when there's a loss, because you're going to feel terrible. I mean, the research shows you're going to feel terrible about the loss. Can't do anything about that. So don't chase returns so you didn't buy too high. Excuse me. Hold on. Ooh. Okay. So you didn't buy too high. You did not use money that you're going to need, right? Because you're going to feel terrible about the loss, and then you're going to feel panicked that you need that money. And you're going to watch the market, you're going to watch that money shrink, 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 shrink. And that's going to make you panic and want to pull it out. So only money that you're investing is money that you do not need for the next 3 years. Okay. The recency bias, right? So these pitfalls that you're going to avoid, what happens over and over and over again. And I'm not like a day trader, but I definitely watch the market and I take advantage of other people overreacting to recent news, because it's so silly. I mean, like I said, any stock can have a bad quarter. And then to watch that stock get pummeled, to watch people overreact, to watch, a relatively good investment get overly punished is just so silly, and it happens all the time. So that's this recency bias at work, that whatever the recent news is having an outsized impact on a stock. So knowing that that's a pitfall for other people, it's like, you're not going to make that mistake. You're going to not let bad news send you into a panic, right? Because you're going to take the long view on your investments, right? Because I mean, even if the news is like the CEO is resigning, it's okay. I mean, Peter Lynch, one of the best investors ever, talks about how, like, really, you want to pick companies where, like, anybody could run the company. This is not the end of the world, right? The well-run companies kind of run themselves. So you're going to avoid overreacting to the recent news. And again, of course, like, you're going to avoid the pitfall of, like, whatever you think, you're just going to look for evidence that confirms what you think, right? So you're going to have pros and cons. You're going to be actively looking for the cons. So if you, I mean, Bitcoin is like over $100,000 right now. I would never invest in Bitcoin, but especially at these levels. So, but if you were tempted to, then the confirmation bias, you don't go out there and look at, like, the stories of the people who've made a lot of money in Bitcoin. You want to look at the opposite. You want to look at the track record of Bitcoin. You want to go back to the times that it dropped 80%, right? You want to make yourself look at the cons case, not just your pros case. Okay. So profit from the bias of others. I think you can see where this is going. If people are panicking, I mean, really at the end of the day, right? It's not that complicated. It's not easy to do, but it's not complicated. You are trying to buy low and sell high, and there are always opportunities to do that. So we literally just went through this opportunity. I'm trying to remember when the market got really, really, really bad. I mean, it started to decline in January and February, but I think it was the beginning of April where it really just got to be the worst. And I was buying so many things. Like, I was buying more of the stuff I already owned that I believed in, right? So, I mean, there's so many examples of, like, and I'll mention, specific investments, but this is not advice. I'm not saying that you should do this. But for example, like T. Rowe Price is an investment company. They run a lot of 401ks for different companies. They're just a really, really good company. And they got pummeled, and they have a fantastic dividend. But again, this is not investment advice. I'm not saying go out and buy T. Rowe Price. But, I think it had been around $112 a share, and it went down to $74 a share, like in a month, just on the tariff nonsense. And I was like, that's just preposterous, right? So I'm like, back up the truck. I mean, the dividend alone is better than the risk-free rate of, buying a treasury, right? So while I'm watching other people panic, while I'm watching their bias take over, I am buying, right? So this is what you want to get in the habit of doing. You want to override your loss aversion, right? Just override it. Like, because what's going to happen is, like, when I bought T. Rowe Price, I think I first got in, so I think it had been like around $112, and then it went down to, like, I probably got in for the first time around 100, then bought some at like 98, then maybe a little bit more at 94, but it continued to go down, right? So I'm buying, but I'm saying, like, I'm okay, I'm cool. It went all the way down to 74, and I was just like, well, that's really dumb. I mean, I think I bought some at 82. You have to realize how incredibly volatile the market is, and painfully volatile, and be okay with it, right? And if you can't be okay with it, then only buy index funds and don't look. Never buy individual stocks and don't look. In fact, for a lot of people, that's probably the takeaway, that they should just not be in individual stocks, because watching individual stocks plummet can be very, very, very disturbing. I'm trying to think of which one of my, I'm just going to take a quick peek of my investments, and, like, which one really, really was just so bad. Oh, okay. So there is a company called Wheels Up, and the ticker symbol is UP, Wheels Up. So private, I mean, I guess the closest thing would be NetJets. I mean, I don't know that much about NetJets, but I'm just sort of assuming it's the same idea that people who have the means to use private, take private planes, they go on these apps and they just kind of figure out like, what would it cost if I rented a private plane to go from like, LaGuardia to Britain or something, to London, right? And the app will like spit out some number, you can take 6 people and your dog and it'll be $30,000. So Wheels Up is another one of these private carriers. And you can book the private plane on the app. Well, it was recently at like $2 and it went down to 80 cents, right? And I'm not even sure why. I'm not even sure how tariffs impact private air travel. It's like everyone's going to lose their money. Nobody's going to have money for private air travel. So I was a buyer the entire time as it went down, and it went up 100% in like the last 10 days. So it's at $1.60 now. So I'm very, very happy. But you have to decide for yourself, are you the kind of person who can do that, who can watch some, like it really helps if you have very strong conviction about what you own. Probably the first rule would be like, make sure you feel strongly about what you own. Don't own things that you don't understand. Don't own things that somebody else told you to buy. Like really understand what you own. And then if the market starts to decline, you should be buying more if you really believe in what you own. Not necessarily right away. I mean, it can take a while for like these things, I mean, you can buy on a dip, but this tariff thing was a heck of a lot more than a dip. But if you really, really believe in what you own, like the Wheels Up and the T. Rowe Price, neither one of those should be like losing that much value. So you're going to override your loss aversion. You're going to override your recency bias of thinking these headlines are so calamitous. You're going to override the confirmation bias of like just looking around and like whatever you're already thinking, you're just like backing that up. But most of all, you're just going to buy low and sell high, right? And you're going to do that while other people are doing the opposite. And that's really one of the takeaways from these biases, is that they impact other people. So you can take advantage of staying cool while they're in a panic, right? And then it works the other way around. So one thing I noticed is that it's so different today than when I worked for Kiplinger's Personal Finance magazine. So that's how I got my start in this business, was working for Kiplinger's Personal Finance magazine. And when I first started there were so many thoughtful articles on when to sell investments, right? And you don't hear that so much today. There's this sort of like Warren Buffett idea of like buy and hold forever, which he, by the way, doesn't even do. So take that with a grain of salt. But the flip side of like, don't panic is also, and definitely don't chase returns, is also like, if you have a real sense of what you own and it starts to get, the value is just really, really high relative to where you bought it, relative to where you think its prospects are, it's okay to sell, right? That's not timing the market, right? That's different. Timing the market is different. So if you're just in an ETF or an index fund that is like, has, like, say it's the S&P 500 and it's 500 different investments, that's a very different choice than selling a specific stock, a specific company, because you've seen that it's gone up, 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 up. So for example, the Hokas, back to the Hokas, I love DEC. DECK is the ticker symbol. I love Hokas. I love Uggs. I love this company. I'm going to sell. It's going to recover and I am going to sell. Like I don't need to be in it forever. So if it goes back to those lofty valuations, I'm out. And so this is the opposite of what people do, is that they, some people never let their winners run, but other people hold on to things for way too long because of a sort of inertia, right? So there is another bias. It's not called inertia. But it might as well be called inertia, where it's like, we just don't change when we should. And if you have an investment that's really appreciated in value, maybe you should sell it. Anyhow, I want to pause for just see if we have any questions. I'm going to check the chat one more time.
No question.
I don't think so. All right, well, that's what I got for you guys. Buy low, sell high, avoid the biases. Oh, and the action bias, I want to say, as I'm talking about, like, if something really gets too high and you should sell it. So the action bias is not don't take action. The action bias is like, when you're triggered by something, when something is like kind of frightening, that's when you want to sit on your hands, right? Don't just do something, stand there is kind of the joke. But taking action when necessary is important. So overriding inertia is very, very important. But yeah, so that's your introduction to the psychology of investing, and it's really based on a lot of great academic research. I mean, this is truly what's out there. I do think I picked the most relevant topics, but certainly, any given Saturday, you can sit down to your computer and Google cognitive biases and see where you land. I almost included bandwagon effect. That's kind of, sort of following the crowd or herd mentality or things like that. That might be the only one that I would think would also be compelling, but there are a lot of them. And, if it resonates with you, you should check them out. Well, thanks, everybody. If you have any questions, please put them in the chat.
Or you can unmute yourself if you have a question.
Or unmute. And then Young, all the stuff that's coming up, that's already in the chat, the Julie Jason one?
Yeah.
Oh, perfect. Perfect. I might sign up for this Columbia guy. So he's talking about helping people become literal traders.
It's talking about strategy.
Interesting.
There's one comment. Thank you. Great informative topics.
Oh, great. Oh, wonderful. You're welcome. Thank you for joining us.
Yeah, take a look. It's a Thursday evening in July.
Yeah, I think I'll join that one. That'd be fun.
That is kind of for advanced individual investor.
Dr. Harry Mamaysky?
Mamayaski.
Mamayaski. Okay.
Every time I have difficulty.
Yeah.
We did one program here last year. It was very well attended.
That looks very good. Huh. I love that stuff. Oh, he's going to explain the CAPE ratio. Okay. All right. All right. Well, if we don't have any other questions, then I will see you at the next program.
Okay.
Oh, I guess that's the one thing I should have said was our next program. Planning ahead, June 10th, The Millionaire Next Door.
Yeah, that is the end of this year. We take July and August off. So we'll come back in, after June, we take July and August off and then start from September again.
Exactly.
Okay, thank you, Kristen. Thank you everyone for coming.
Thank you, everyone.
Good
Have a great night.